All right, Jonathan. So I bought my house a year ago, and I'm pretty sure it's worth a lot more money now.
Oh, yeah.
How do I get rid of my stinking PMI?
That's a great question, Austin. That's what today's video is all about. So we know that the market has been crazy the last couple of years. If you bought our house, your home's probably worth so much more. And a lot of clients are asking right now, how do I get PMI? How do I get rid of it, Austin?
Well, the first thing we got to look at is, why do you have it? So when we're talking about PMI, we're talking about conventional loans. It stands for private mortgage insurance, and that's what's in place whenever you put less than 20% down. So you put 20% or more down on a house, you're not going to have PMI. But you put less than 20% down and that first lien position's more than 80%, you're going to have private mortgage insurance.
That's right. And so one of the things a lot of borrowers don't realize is anytime you start a loan with mortgage insurance, you have to make at least 24 payments or 2 years of payments towards that PMI before you can even try to cancel it.
Yep. So what we want to look at is, how do you get there? So there's two big ways to get to canceling your mortgage insurance. There's appreciation, and there's payments.
That's right.
So walk us through the appreciation piece.
Yeah, so kind of like we're talking about, your home is probably worth way more than what you purchased it for. And so whenever a lender is looking at the equity position in your house from a private mortgage insurance, they're looking at where the loan balance is versus where that original appraised value is. So the only way to really expedite removing your PMI, Austin, is to call your mortgage servicer and request that they order a new appraisal to validate that new value. And so one of our examples, we have a $400,000 house that's potentially now worth $500,000. And so if you pay $400 or $500, which is probably what you would get charged, to get that new appraisal and then validate that $500,000 value, and if you're past the 2-year mark, then the servicer will go ahead and remove that PMI.
Yeah, key piece. We got to be past the 2-year mark. And then if the appreciation's there and we can substantiate that with the appraisal, you're good to go, and that PMI is going to get cut off. The other way we get there is through just the payment history. So if you're just aggressively paying that sucker down, we can also get to that 20% mark.
Yeah, that's what we call your amortization schedule. So every month, principal and interest goes towards your mortgage payment, but every month more and more principal gets paid down. So that loan balance will move down. In general, if you put down 5%, it might take 5, 6, 7, or 8 years to get the amortization schedule to where that loan balance is now at 80% loan to value, and you can get that PMI. So sometimes it makes sense to try to expedite it, Austin.
Yep. So those are the two ways you get rid of PMI. If you're on a government loan, you've got an FHA loan, that is called MIP. It's essentially the same thing, but that sucker's in place for the life of the loan. So when we're talking about PMI, we're talking about conventional loans, and there's a way out. You just have to be in it for at least 2 years, and you gotta either pay it down or you gotta have your home appreciate to where you're past that 20% equity mark. And that's it for today. So if y'all have any questions, you know how to reach us. We'll see you around. Adios.